Good evening and welcome to the Money Show. I'm Kavita Thapliyal and this is the show where we put your money to work for you. How investments are different from just savings and how should you be placed across asset classes, how your existing investment strategies are aligned with your financial goals. This is the focus of the show, and we also do your life financial planning, your portfolio planning on the show, just in case you want to get a checkup of your portfolio or you are new to investments. Send across your questions on the number that's flashing on the screen. That's the WhatsApp number and the email ID where you can reach out and ask for guidance from our experts. But today we decode a market that's walking a tightrope, volatile, uncertain, yet full of selective opportunities. That's right. With global tensions rising, oil risk looming, and investors questioning returns, where should you really be putting your money? Joining me is Aditya Mulki of Navi Mutual Fund to break down what's working, what's not, and what investors must watch out for. Aditya, hi. Welcome to the Money Show. Aditya, amid heightened volatility, investors should refrain from taking aggressive positions, and instead let the uncertainty cool off. So that's a very traditional thought process and often right, especially the times that we are into. But what's going to be your take on the overall market sentiment at the moment?
Yeah. Hi, Kavita. Thank you for having me on the show. So our take on the current market environment is that we believe consensus isn't the consensus expectations baked into the market right now are too high, and the earnings projections that have been made for FY27, FY28, we believe are on the higher side. And in our view, also the current geopolitical situation is so uncertain and everything is just hanging by a thread. We expect the tensions to continue for a prolonged period of time than what most other market participants are expecting. And apart from that, we believe people are not really pricing in the damage to infrastructure that has happened over the past few months. That is going to take time to come back, right?
Okay.
If it takes 6 months or a year to come back, that will have implications in terms of earnings growth for a number of companies.
Right.
That is not getting fully priced in the current markets. So we believe there is a bit of downside still left to the markets. However, as you said, times like these are rare in a market like India. And apart from something like a COVID or something happening, it's very difficult for investors to get this type of a buying opportunity. So we do recommend that you buy, but you stagger your purchases because we don't believe the worst is over yet.
Right. All right. So from the economy point of view, Aditya, I want to understand what are the red flags that you are looking at?
Yeah, absolutely. So a few key red flags that we are looking at. One is crude oil prices. So we believe crude oil prices will remain close to, let's say, $100, $90 to $100 for a prolonged period than what most people are expecting. Now, that will have its own implications. It will lead to a deterioration in your current account deficit. It will also lead to possibly inflation rearing its ugly head again. That will then have a lot of impact on a bunch of sectors. It'll have an impact on demand. It'll have an impact on consumption, and so we believe oil prices right now is a key monitorable with the and as I said before, the damage that has happened to the infrastructure over the past few months, that's not going to just come on board overnight, and that's going to take its own time. So we believe oil prices is something to watch out for. Apart from oil, something that oil actually also impacts is the currency. We've seen currency be in a free fall and crossing the $90 sort of mark.
Right.
We expect this to and this actually remains a key monitorable, and this will also have a key impact on a lot of Indian companies as India still today from a corporate standpoint, we do remain importers, and that will have the currency will have its own impact. Apart from that, something that is not much talked about, I would say, is investor expectations.
Okay.
Currently, the SIP discipline has held up well. Investors have not really cancelled as much SIP in the current environment, but as they keep seeing that the returns are moderating, especially investors who've entered pre-COVID, post-COVID, and have only seen more than 15, 20, 30% returns.
Right.
once they see that returns have moderated to 8, 10%, 12%, so that we believe investor expectations is something to watch out for. You could see possibly higher cancellation than SIP, and the SIP story that has been created and that has sort of even showed up the markets from FII investments, and you see that change if investor expectations are not met this year.
Where are you seeing the pain as far as inflow is concerned on your books?
So for us, to be honest, Kavita, inflows, markets, the investors have evolved so much. For example, in March, the markets were down by around 10.7%. The Nifty was down by that much. But we actually saw a lot more flows coming in than the last even 12 or 15 months. So investors understand this today, that whenever there's a fall, you accumulate more units. So that is being quite good. But now the question is, what happens if this continues for another few months? It's relatively been a better month, but let's say now in June, you see that, and that's when it'll be very interesting to see the impact of the on inflows would be.
Sure. Which category is doing well for you in these times also?
So in these times, similar to the markets, if you look at the flexi cap category, for instance, flexi cap category has done quite well. Even from a market standpoint, you've seen a lot of gross inflows in the flexi cap categories. Then for us, even some of our passive large cap categories have done well. So we've seen a lot of inflows in these categories, which is probably investors trying to not take too much risk and go into possibly a mid or a small cap or a thematic, or taking more sectoral bets. We haven't seen a lot of that, to be honest, over the past few months.
Right. So you are active and passive in the large cap category, but you are mainly passive in the mid cap and small cap category. Is that right?
Yeah, to an extent, we do have a large and mid-cap fund on the active side, but you're right, on the small-cap side or pure mid-cap side, we are largely passive.
Sure. The reason why I'm mentioning this is because we've seen a narrative change in the mid-cap and small-cap category. If you must have seen the latest AMFI numbers also, a few months of slowdown, and then again a comeback in the mid-cap and small-cap category, which is almost equal to large cap or a flexi cap. How are you looking at this trend?
Yeah, you're absolutely right, Kavita. The flows in the mid and the small cap category have rebounded over the past couple of months, and valuations actually, the valuations looked attractive a couple of months back, but those have now gone off. If you look at the small cap space, it's trading at a trailing multiple of around 30 times, which is quite high. The mid cap continues to trail at its long-term average of roughly around 32 times earnings, so which is quite high. So the mid, so how we look at the mid and small cap space, Kavita, is that increasingly in India, if you have a time horizon of, let's say, 7-8 years or even higher than that, you should take significant exposure to mid and small cap. And why we say that is because the large cap, we believe, currently does not capture the breadth of the Indian markets. And they are quite underrepresented in certain sectors. I believe that's a good space, but you're right, the flows have come back with a bang. And now, to be honest, the valuations are all that great for people to be aggressively entering at this point.
Absolutely. You know, one really needs the large cap category to provide stability in the portfolio. But having said that, selected opportunities are there in mid cap and small cap. Talking specifically on small cap, see, the universe is very large in the small cap category. How do you think you will be sectorally, structurally placed in small caps?
Yeah, absolutely, Kavita. So currently, to be honest, if you talk from a sectoral lens, there is no sector that we could come out and say that, okay, that this sector looks a thump on the desk sort of a buy. There is nothing of that sort. But you're right, the small cap universe is so large. There are a bunch of opportunities that we see from a bottom-up perspective, wherein business models have not really eroded, but just the narrative or the sentiments that are out there have led to the correction in these stocks. And I'll give you a few examples out here. One is you could look at some parts of the capital goods sector. For instance, something like a defense or a power equipment sort of place. If valuations are not too high, these plays, in our mind, look very attractive over the long run, because there are a lot of demand tailwinds in both these spaces, both power equipment, and in defense as well.
Right.
Secondly, we do see a lot of tailwinds even in a healthcare space, and within healthcare, I'm talking about hospitals, specifically hospitals. India has an average of 1.6 bed per 1,000 people, and that has compared to a global average of 3.3. Just that alone, the doubling of that alone will lead to a lot of tailwinds, both on the demand and on the margin side. And apart from that, the listed players only hold around 3% of total beds right now. And they're expanding aggressively. So a very good long-term story in the hospital space as well. So these are two spaces, Kavita, in the small cap segment wherein we do see a lot of value plays currently.
Great. Okay, so capital goods and healthcare that you're talking about. So we are assuming valuations already running ahead of fundamentals over here?
In some cases, yes. In some cases, actually not. Especially in the case of hospitals, you will find very good valuation plays as well. In defense, you need to be selective when you look at cap goods, because the space has always been priced at a premium. But in the hospital space, you will find very good names that are trading at very reasonable valuations.
Sure. So this is going to be the long-term story that you might want investors to keep in their portfolio, or have the participation there. But what about auto? Earlier this year we saw a lot of things coming up. We expected a lot of things coming up in the auto and auto ancillary space, especially after the GST mouth. So we were expecting the balance sheets to reflect, all the positive impact of that. But monsoon is a great concern for us over here, looking at the El Nino and its placement. How are you placed in the auto sector? Are you on the sidelines? Are you waiting for opportunities?
So I'll break this down into auto and ancillary, Kavita. So on the auto space, we remain close to index weights on the auto space. We believe in the long run, India is a consumption market. And if you look at the kind of cars that people can afford today, is different from what it was 5 years before, right? So we do see demand tailwinds there in the auto space. But to be honest, we won't go and be overexposed to the sector at the moment. Secondly, on the auto ancillary space, now this is a very interesting space, Kavita, because for us, around 6 to 8 months back, we took a conscious call wherein we went massively overweight auto ancillaries, and that has played out very well in some of our active schemes. And auto ancillary has been a play on premiumization, on EVs coming in, on content per vehicle increasing. So that is now, we believe, that has now played out in the auto ancillary space. We're actually looking to now go slightly underweight there. But we always like to prefer to play autos through the ancillary route because their businesses are far more sticky. But we do believe the story there has played out because the valuations, they look to be pricing everything in at the moment.
Any specific focus on the EV theme?
So we are looking at EV, but we are looking at it more from a lens of a two-wheeler or a three-wheeler EV. From a four-wheeler standpoint, from an OEM standpoint, we do like a couple of names out there who have done well in the four-wheeler space. But mostly for us, from an EV standpoint, we are still looking at two-wheeler and three-wheeler. But to be honest, Kavita, the infra for charging, we believe that still has ways to go. And we do see widespread adoption of EV. But in the two-wheeler side, you will see that improve going forward. And that is a story that can be played right now.
Sure. Let's talk about BFSI, Aditya. What interests you over here? I mean, if one is to really initiate a strategy now, what is going to be your view also? Whatever the results are out so far, how's it looking at?
Yeah, so BFSI is actually quite an interesting space, and we like the space quite a bit because the recent correction has led to the space trading at a significant discount to its long-term value. It's at a 20% discount on a trading basis, which makes the space quite attractive. With BFSI, actually, we've from the numbers that have come in currently, we have seen, we've noted a few trends in terms of your MSME books, your microfinance books. It seems like the asset cycle, all the slippages that they were reporting, it seems like those have peaked out. we believe that something like a space like a small finance bank, some place could actually look very attractive going forward. And within the larger set, we do like some of the larger private banks who've exit, because we believe their execution has been quite stellar, and the numbers that have come out this quarter have been quite they've been quite robust numbers in terms of growth as well as asset quality. So looking at the BFSI space, there are some interesting names in the NBFC segment as well. Some vehicle finance names that we believe they look ripe for a re-rating at the moment.
Okay, sure. Out of the banking sector, PSU or private?
For us, currently PSU.
Currently PSU. Okay, let's also talk about new age and maybe quick commerce. That is catching up on investors' interest really quick. Are you also excited in this space?
Yeah. So how we look at quick commerce, Kavita, is that quick commerce for us, obviously, these are part of this sort of a platform business. We believe these companies, they do have a platform which is very valuable.
Right.
They do delivery on it. They do quick commerce on it. Quick commerce is the cool thing to talk about right now.
Yeah, totally.
Yes, we believe the lifestyle of people have changed to such an extent that these things aren't just going to go away. So people might have concerns in terms of profitability in the near term, but we do believe on the ground, the way the people's lifestyles have fundamentally changed. That played out initially in food delivery, and that will play out in commerce as well. So we do actually like these business models quite a lot, and we believe the platforms themselves are very, very valuable, and they will continue to be very valuable in the long run.
Okay.
We actually look at these businesses positively in the long run.
All right, let's talk about the elephant in the room, IT. Definitely a disruption, or maybe a temporary disruption due to AI, structural threat to the entire sector. But then, Aditya, the other side is steep correction, closer to the bottom. Are you interested in AI, in the IT?
So we did go underweight. We were heavily underweight IT over the past few months, but right now you're right, Kavita, wherein you've seen 30% corrections from their long-term valuations. Sort of looks attractive from a valuation standpoint, but you would also look at the business itself. The dust over the impact of AI has yet not settled. There is definitely going to be a deflationary impact on the pricing of IT services contracts going forward. That is going to happen. It's not that the contracts are going to go away, but the price at which they're going to happen is going to be lower. Competition is going to increase. So we do see that the headwinds in IT will continue, but at this juncture, given the valuations, we would like to be stick close to benchmark weights in IT, because they are now starting to look quite attractive, and I think the street is underappreciating the business models in the long run.
Right. So, looking at the IT sector and the trajectories, these kind of changes have obviously helped the larger IT players or the large cap IT players to really transform. And although it's not going to be a very smooth transition for the mid-cap IT, but can we look at mid-cap IT at this particular point in time for a longer term horizon?
You absolutely can, Kavita. To just summarize that in short is previously what was happening is whatever happened, large cap IT service companies, the they had was they had a track record of doing very large contracts, very large contracts, and because of that they had a very strong employee bench strength. The number of employees itself was so large that they were the only guys who were able to execute these large contracts. It became sort of a chicken and egg situation for a mid-sized IT companies, wherein it took time for them to scale up. It took very, very long. And to be honest, some of them have not yet reached the scale of an Infosys or a TCS. But now what is happening is with AI coming in, it is sort of an equalizer, right? You don't need that many number of people. So that will have a positive impact in our view on mid-sized IT companies, wherein their ability to compete for these large contracts over time will improve. And it will sort of level the playing field. So to answer your question, Kavita, it'll be a very, the space looks actually quite interesting, mid-cap IT.
Okay. All right. What's new for Navi now? What's in pipeline?
Yeah, so currently, Kavita, 90% of our AUM does come from passive funds, from index funds, but we've always had active schemes, and our performance in some of our active schemes have hit quartile one right now. So we are looking to focus on our flexi cap scheme on continuing the performance and letting the good performance flow into the 3-year, into the 5-year performance, and then if we believe in this industry. It's better to play the long-term game and let the performance do the talking, and then the investors follow suit. Once they see performance for a sustained period, we believe the AUM growth will happen.
Sure, sure. Aditya, you're also in the business of, figuring out new trends or spotting new themes. Obviously, we are looking at Viksit Bharat, and that's a major theme across sectors that people are banking on. What are these underlying trends, if anything, that you have figured out when you sit with your fund management team?
Yeah, Kavita. One trend we believe, if we talk about sectors also in particular, we believe manufacturing is something that people have sort of forgotten about, but we believe that could make a comeback in a big way. With the government launching these PLI schemes, the first tranche of PLI schemes that have happened have led to positive impact, and we've seen the government building upon that, and that will have its own implications. And with the world becoming more inward looking, every country is looking to build up its own manufacturing base. A lot of Western countries are looking to diversify out of China, and that will also, and with India being one of the preferred suppliers. So we believe manufacturing is a trend wherein people are not looking at it too much. It's not a very, you could say, a very glamorous business. It's a very simple put in factories, that sort of old school business. But we believe that could make a comeback in a big way.
All right, with that, we let you go. Thank you so much. Lovely talking to you, and the kind of inputs that you've given will really help our viewers strategize their investment portfolio today. Thank you so much, Aditya. And with that, it's a wrap on the show as well. But for the viewers, I'm going to leave you with our WhatsApp number and email ID where you can reach out and get connected with our experts. Thank you so much for watching. Goodbye.